What's going on, everybody? Welcome back to Wealth Webinar. Today is going to be an epic episode. Today, you're going to hear a lot from just a phenomenal person, Kerry, who is literally somebody that we look at. We watch all of his reports and everything he does to learn where we're going. But it's not so much important where we're going in the markets and where we're going with our investments. It's where we were that then can help us get to where we're going. And Kerry is just a wealth of knowledge. And I want to preface real quick, and I'm just going to share my screen here real quick. I've got their website. So this is something a lot of people, when you're in the space, you hear about family offices. Okay. Andina Family Offices is someone that we've gotten to know, someone that we've built a relationship with. And it's one of those things where, a family office is for extremely high net worth people and families that need to have management. And it's done completely different than your traditional financial advisors. But one unique thing about this family office is they can and will work with you at specific asset levels. And it's not what a traditional family office would be. They've developed a program to work with I don't want to call it the average person, but somebody with maybe 250,000 to 500,000 in assets. And they can help you with the things that normally a family office would only be able to help the higher net worth individuals. So Kerry, welcome to the show.
Thank you.
Absolutely. So I think it's important that we kind of just start. What you do a weekly show or a weekly report, correct? Can you just tell everybody about that? Let's give them a little value right there.
Sure. One of the big problems we find is that the financial industry has made themselves complex because they need you to hire them to do the work that they want you to do. And so what we try to do every weekend, it's called the Weekender. We just simplify everything that's going on economically because, frankly, economics drives markets. So economically, down to the markets, and most of our clients are business owners. So we want them to know, how does this translate into your business? And so we publish that every weekend, and it's fairly short. It's usually between 10 and 20 minutes. And it's wonderful because if you can't sleep at night, I have that kind of voice that lulls you into somnia. So I'll keep you falling asleep as you listen.
No, they're wide awake. They're right on the edge of their seat. But you're right. Like a lot of the economics and all that stuff definitely, can bore people. But I think what's important is the way that you explain it in your report and what you do. And we've listened to it, my entire team who, yes, I come from the Wall Street world, but, Shauna and the team, they do not, but they still listen to it. They love it and they learn something. They hear me babble all the time about the economics and the current Fed trifecta and all the things going on out there that, are just doom and gloom in some case. And then they hear you talk and it's a completely different light. But, I really want to go into just a little bit about, the history of the markets and kind of, we don't have to go back too far, but wherever you want to go, can you kind of just paint a quick picture that the things that we're seeing in today's markets and all these different things, these aren't, a lot of people are like, this is unprecedented. I hear this all the time. Not so much. What the Fed's doing has happened 6 or 7 times. The inverted yield curve has happened 6 times. There's all these things have happened. So if we just go back and we look at what these things were back then and how they impacted the markets and the economy, we can kind of get a good forecast of what might be coming. And then we can make some educated decisions based on our risk return profile of how we should invest our money. Do you want to start there?
Yeah, absolutely. That's a great place to start. And I will try to not do too much history. I am also a professor, which makes me babble. So I will try and reduce my babble quotient and share some things. Can I share my screen?
You sure can.
Let me do that. And I'll just share my Bloomberg terminal so you can see the graph. You should be able to see a graph right now.
Yep.
This is the S&P 500. And what we did is we started it right here, whereas the bottom in the 08-09 financial crisis. And here, tagged up here to the bottom that we had a few weeks ago. And we're up 516%. So despite all the travails, the ups and downs, and certainly we've had a few, that's a 15% annual return. That's pretty remarkable. But it's in the environment that is very different. Let me give you just a little bit of farther genealogy, in 1987, which most of you don't remember, Alan Greenspan was put into the Federal Reserve as chair. At the same time, we sort of had this evolution and revolution in computers. We learned how to analyze things faster, and we gave analysis capabilities to the common person. And that gave us a bit of hubris. That made us think, you know what, these systems that we've been relying on seem like sort of a black box. And I think with computers, we can actually open that box up and see what makes them tick. And enabled us to have this bit of a sense that we could manipulate the financial system in ways that would take away some of the cyclicality. And so from that point onward, the federal government, especially through the Federal Reserve, became much more active in financial markets and the economy to try and keep it smooth. And so from the credit crisis in 2009, when we ended everything, to really the bottom we experienced a few weeks ago, we have experienced what is called a Goldilocks environment. So if you were to take yourself right here to right where we were right before the pandemic, we had this odd environment where it was driven by slow but consistent economic growth, very low inflation, and that low inflation drove into low interest rates. We had very resilient labor markets, which means we had a labor market unemployment rate low of 3.5%. That's really low. In fact, most economists think that's fully employed because there's always people bumping around looking for new jobs in and out of the market. And that 3.5% we thought sort of reflected them. And so in the same period, we had this peak operating margins and peak valuations. So we really entered the pandemic in a Goldilocks environment where we thought everything is just right. Now, the pandemic was treated not by the Fed or governments as an event that happened upon us, but as a cycle. And so they took cyclical measures to treat an event. And that is what's creating what we call a policy error. And that's what made it so they were behind the curve. They weren't able to respond quickly to quickly responding events because they saw this as, this is a cyclical issue. We need to treat it cyclically instead of, this is a trauma issue. We need to stabilize the patient and move them on. So that response created a host of errors, and that they saw is this. And this is the unemployment rate in the United States during the pandemic. And as you can see, we're up higher than 14%, a number we'd never been to before. And over the course of the last 2 years, that unemployment rate has dropped dramatically. What's particularly interesting, and please, in the course of the discussion, stop me anywhere and ask questions, because otherwise I will just go. But over the course of the pandemic, we experienced some things that we had never experienced before. Over the last 30 years, we've built up what is known as the just-in-time inventory process, where we thought we really don't have to hold a lot of inventory because global commerce is humming, transportation is easy and relatively cheap, and that makes it so that we can push inventory farther and farther down the chain, eventually to the groups that actually make the products or the components. What happened during the pandemic is, first in February, China shut down, then in March and April, the US shut down, and then over the course of the intervening months, it was pretty slow getting things back up and running again. And so we broke a supply chain that we had pretty well honed in, and that has created shortages. So over the course of the pandemic, we experienced a number of things which were quite remarkable and frankly, very different. This is personal income. Now, what you can see obviously is this line should be trailing right where it is now, but these jumps, these bumps, were excess payments given by the government to people for nothing.
I would have never believed that they were that big. I mean, really, the checks that they got in those stimulus, checks weren't all that much. It made that big of a blip in the overall income.
It's remarkable, and this is something that most people don't see. But
I've never seen this.
What did we do with that money? We obviously spent it. What we did first is we saved it. So this is what happened to our savings rate. Our savings rate as a percentage of disposable personal income took off because we were all sort of freaked out because we were all told to go home and stay home. And and not come back until the all clear is given. So what happens is you jump it into your savings and you wait for the all clear. And as
But
the
look
all
at it
clear,
now, it's fallen below where it was before.
absolutely. And
That's
that is
frightening.
perhaps the most powerful comment, is that the government gave people money. They put it in the stock market. They bought a house with it. They bought other stuff. They forward purchased things that they normally would have waited on, things like washers and dryers, computers, big ticket items. And those big ticket items usually drive the economy in a more consistent manner. But because we gave people lumps of money, they found an opportunity to buy things that normally they would have had to save for or use credit for. And that created an environment where you had more demand than you had supply and created shortages.
That's why used cars are through the roof. Boats, you can't even get a washing machine. You can't get a fridge for months. So if your fridge lets loose, good luck. You're not going to get one. So that spurred up this whole black market, not black market, but secondary market of used goods because they can't get new goods in time. I've never seen this, but you know, it's like, I remember hearing that savings rates went way up. And then I also kind of knew, but I never saw the graph of how low they actually fell because they did all these forward purchasing. And I know debt's played a major part in this because, you know, we've studied extensively the debt cycles.
It's too hot for him to wear a sweatshirt.
We've studied the debt cycles quite a bit. And, you know, I'm looking at the debt in this country, which is also skyrocketed. I don't know if you've got anything on that.
Well, you know, Ray Dalio's work on debt cycles is absolutely stunning.
That's what we learned from.
There is nobody in the market smarter than that guy.
Yeah.
And he's practical. He lives by principle. Just phenomenal human being. But his research is right on the money. And if you buy his 3 books, it's like graph after graph after graph. You need pills and injections after you're done with it. But yeah, this is information that's interesting. Now, to your point on debt, the debt data was released this morning, and we ramped up the highest increase in percentage terms in consumer debt ever. So we went into the pandemic with consumer balance sheets in pretty good shape. And we used some of that money to delever. And now, as you see, savings are going down. So we can't spend that. So what we're spending now is credit. And so that increase in indebtedness, not just from the mortgage side, but now from the consumer credit side, is really starting to weigh on consumers. And it's going to get worse in the times ahead of us. Let me give you a few graphs on what you just said. What's happened because of the shortages, so this is inventories, business inventories. Okay, here we are coming up. Here's March. So March is the pandemic. Inventories start to fall because nobody's moving anything. But look at what's happened recently. We have eclipsed where we were dramatically by increasing inventories, and this data ends in January. So we have March and February that are not included here. And what we have been doing is we've been operating on all cylinders, filling up inventory because we ran out, because the government gave us lots of money and we overspent, but also because companies have said, I am not going to get in this problem again. All those just-in-time principles, sorry, out the window. I'm going to boost my inventory so that I don't stock out again and lose the opportunity to sell. So inventories are now being overbuilt. And the overbuilt inventory situation is going to come back as the chickens back to roost here in another quarter, where we have more inventory than we have demand. But right now, there's more demand than we have inventory, and we are going to continue to build. The problem with that, it works great for you if you are able to pass on the cost to your consumers. And so far, we have been able to. Companies have had a remarkable ability to pass on prices because we have lack of product. But as inventories become rebuilt and product becomes more readily available, that pricing power goes down. And in fact, the opposite occurs, and companies start to reduce prices to try and clear the inventory.
Called
deflation. Yeah. And what's happening now, though, this is the CRB RIN, which is just the raw commodity index. It has never, ever, ever been higher than it is today. So to the extent that these raw commodities, and this is like iron ore and wheat and oats and things like that, to the extent that these products and the prices for these products are transmitted beyond being raw and transmitted into the final products and then to consumers, the prospect that inflation is coming down soon is probably a bridge too far. I think we're in a position where this has moved so fast and so high that we're going to see inflation for a little while. If you look at food prices, this is the UN food price index, never been higher. This is a particular concern, not necessarily for US consumers, but for those abroad, in particular for countries that are poorer. So pricing for basic foodstuffs as tracked by the UN have never been higher, and we're higher by an enormous margin. And this causes want, causes hunger, and causes revolutions. So the standard deviation we've moved from the average is very consistent with what is typically something that sparks revolutions in other countries. So you want to be a little bit cautious of that.
So Carrie, you got this knee-jerk reaction, companies overproducing to fill the current demand with cheap money, because they printed what, 5 trillion and counting, in money, but they were also buying bonds to the tune of well into the hundreds of millions a month. And they've stopped that, they've tapered that. And now there's talk of the Fed unwinding the balance sheet of about 8.9, maybe give a little 100 here, 100 there, $8.9 trillion worth of mortgage-backed securities and treasury bonds that they're talking about dumping some of them into the open market, or selling. Dump might be the wrong word. And I've heard rumors of 50 billion a month. I've heard them as high as 80 billion a month. So that's going to be it's going to hurt all this. If you got all this extra inventory that people need to sell, prices are going up, and then they're going to start sucking liquidity back out, along with raising interest rates another 6 times this year, which we've only seen one rate increase. But look what it's done to the 30-year mortgage industry. I mean, rates have gone from low 3s to now you're over 5% on a 30-year mortgage. Like where is the tilting? Like if this is one of those balancing things, where do we break the balancing? I don't even know if it's going to go to the other side. Where's it just split in the middle?
Well, I think your point is a great one. And that is, once the genie's out of the bottle, how do you get the genie back in?
That's what I was trying to say. Much easier way to say it.
And
get that genie back in the bottle.
And the reality is, and that nobody likes to hear this, and I'm always criticized for being too depressing, but the reality is you have to break consumer demand. And unless you break consumer demand, you won't fix the problem. So the problem we have is we've never had as robust a labor market as we currently have. We have 3.6% unemployment. We have never entered into a recession with such a low unemployment rate. We have 10 million job openings. So we have so much demand for labor and so tight a labor market that in order to break demand, to create demand destruction, which is what we have to do to be able to get the prices to come down, the Fed's going to have to go a lot farther than they think and than most people have projected. And so rates are going to go higher. This is the 10-year government bond yield. So, when I mentioned we have to start talking about inflation, which we haven't done for a long time, these are bond yields on the 10-year government bond over time. And you can see they've just gone down, 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 down until we hit a low close to the pandemic. And this is a conversation that we just haven't had to have, because on the margin, money became cheaper and cheaper and cheaper, which made inflation lower and lower and lower for longer and longer and longer. And we just took inflation out of the equation. It was not in the discussion anymore. And that is a change. And when you start talking about inflation, you start talking about purchasing decisions, and you start buying less, and you start destroying demand. If you were to take this graph and just change the date, so let me just move it off to the beginning of 2020. What you see is something remarkably different. This is the 10-year bond, same thing, just a different time frame. And what we've seen is from the position of the bottom, which is right here, the 10-year government bond yield has risen by 413%. Again, in the financial systems, everything is priced on the margin. And that is a change that we have not even come close to incorporating in the US economy. And the thing is, this is only 2.6%. So it's well below inflation. If inflation does come back to the Fed's target of 2%, the 10-year bond still has to be 3.5%. So I think we just haven't reset our expectations, haven't changed our models to reflect a world where, at least over the next 3 to 5 years, inflation is going to be a thing we have to talk about all the time.
So with inflation, I mean, the Fed's answers, always, pretty much the same: raise interest rates, make money more expensive, suck money out of the markets to make it, a little bit harder, or, just start curbing that. But they've never successfully, well, I repeat, I correct myself. They've done one successful, as they would call, soft landing, but all the other times that they've tried to do what they're about to do in these, uncharted territories, really, that we've never had, they've failed. So
Right.
what do you think the likeliness of the Fed actually pulling it off is a Hail Mary here?
Zero. And let me explain why.
So we're on the same page.
Let me explain why. This is the Fed's balance sheet. So the last time they pulled it off.
That looks like when I'm trying to draw like this. Yeah, wow, that's crazy. I was going to say something. I'm going to skip.
So this is the scary part, is that this is their balance sheet. So what you're saying is, so we got to this point in 2018, and this is the part where they said they got a soft landing. So you had a slight decline in the balance sheet, but this is different. This is a period where you have a hockey stick graph, and maybe even worse than a hockey stick graph. But the question is, how do you go from 4 to 9? You added $5 trillion in the balance sheet. How do you suck that up? Because if you don't, the money multiplier moves above 1, which it is now, and comes close to its last average, which is 5. And then you have an uncontrollable situation. So whatever they do, they are behind. Now, just to give you a perspective, 6 months ago, the Fed said, I see no inflation. 4 months ago, they said, we see some, but it's transitory. 2 months ago, they said, I think we can handle it, and we'll do what we have to. Yesterday, Brainerd, who was the dovish person on the Fed, said, oh my gosh, we're in deep doo-doo.
I couldn't believe he said that. He's the guy that I would have ever least expected to say something like that.
Yeah, and it was, and would have been the least expected because the most dovish. But now they're in a position where even they're admitting we're behind, guys. And whatever we do, it's going to have to be pretty aggressive to be able to get us to a point where we can get the genie back in the bottle. But the genie has never gotten back in the bottle without demand destruction. So whatever they have to do, they have to go far enough in a growing economy that's got incredible demand for labor and is still trying to refill supply shortages. They have to put the brakes on that type of economy to control inflation. And most of the time, they haven't had to address such a powerful tailwind. So I that's why, it's easy to be, analysts are notoriously strong in their opinions and rarely ever accurate, but the headwinds on the Fed are enormous.
Yeah, and this is what we've been talking about. We just did a 3-day training this past weekend, and I spent the entire first day explaining, all of these items, what they mean, and we called it the what now and what's next. So what I'd love to do now is, and now everybody's definitely probably fallen on the floor because the chart already went by the wayside, that they're seeing these charts and understanding, holy smokes. And I didn't know what you were going to say when I asked you if you thought the Fed was going to pull it off. So I was happy to say that you said that there's zero chance, because I think that's about where everybody needs to come to the realization that there's zero chance. And, we've been in such a long bull market where there's just a lot of people. And I remember being one of them people when I was younger. I didn't know what a recession was. Maybe I'd lived through one, but I wasn't old enough to understand the impact of it. But now a lot of the millennials, the younger generation, even the investors that are coming into the, you hear, I call them the Robin Hooders, they're coming in, they've never seen anything but a bull market. They've only seen, it's going to the moon. And by studying history, the only other time in history that I think we've had something similar was the Roaring 20s. Where literally shoeshine boys were making stock tips. Everybody was making money. Everybody, even the best analysts back then, had that little ticker going, and they were saying things were going to the moon when it was on the brink of destruction and falling apart. And that's just what scares me the most, is the sentiment of investors today is going to lead them off the edge of a cliff. You can see the cliff right there. I mean, how do we get the word out? How do we get people to actually listen and actually take action to prepare for what might be coming, which is a hard thing when you've never lived through it. You don't even know what that means. You just know one side, which is good, good, good.
I think that's a big problem. But if you add to that the temperament of these young investors, and it's always me and my kids, when I was your age, but the temperament of young investors is that investing has become a game. And when you're Robinhood and you've reduced the transaction cost to zero, and when the government gives you the money to play the game, it is a game because you're dealing with found money. And so they're creating this mentality of it's all about the game and it's just playing and it's no big deal. And my daughter's a member of this club. But what every single Fed reaction, whenever they've done this and they've created an environment where they get rid of inflation and reset the system, we always go back to fundamentals. There has never been a time when we didn't. So number one, it's good to know how to measure fundamentals, and you do this with your team really well. But we are going to get back to that point, and we're going to find intrinsic value, and we're going to risk adjust all of our returns, because there's never been a time when that hasn't happened. So I think it's prudent on people to look at your investment portfolio and say, okay, stocks are always more protected than bonds. But what you need to look at is even inside the stocks, because we look at the S&P 500 as a gauge for where it's going, but we have never had 35% of the S&P 500 that doesn't make money. So because of that, they as a natural survivorship bias, they come out of the calculations. And so the S&P 500 is actually much more expensive than you think it is, because those companies that don't make money are pulled out of the equation. So I think you really have to get back to the point where you look at this from a very disciplined way. Ray Dalio is a phenomenal example of that, and say, okay, what should I own? And what I should own is companies who have pricing power, companies that have organic growth, companies that have strong balance sheets. These are basic principles. Return to your basic principles and own those names, and they'll make it through this pretty well, and probably even really well. And the rest of the team will have their evaluations reset to fundamentals.
Yeah, and Kerry, one of the other things, that a lot of the younger folks maybe just don't put the same emphasis you and I do, or, anyone that's been in the industry is, one of the greatest fundamental investors of all time is Warren Buffett. And if you look at his investment strategy as of the last few years, outside of maybe some oil purchases and some pharmas during the pandemic, he's really just sat on hordes of cash. I mean, obscene amounts of cash when everybody else says cash is trash. And then recently there's been a lot of movement for Warren just investing back in his company by doing buybacks of his Berkshire stock. So would it, if somebody knows nothing about the markets and really isn't working with somebody, which they should be, I mean, would that be a good barometer just to watch what he does? I mean, he's a pretty high profile person. He's always in the news and he's not buying, but when he starts buying, would that be a good sign to maybe start looking at it? The other side is near?
I think so. I think there's a couple of things though. And I know Warren very well. I used to be an energy analyst. And so I covered utilities. And so he and I did a number of transactions together. He's a phenomenal guy. But if you had talked to Charlie Munger, who's his partner,
yes,
and you ask Charlie Munger what makes Warren Buffett a good investor, he'll say his capacity for boredom, his ability to sit down with an investment. Because Warren says, look, don't make a decision until you have 80% of the information. He says most people make a decision with 20%. And I think our younger generation is even worse than that. I think they make decisions with less than that. But I think as a competitive advantage for younger investors, discipline yourself to do the research, to make the decision based upon 80% of the information. And nobody knows what 80% is, but it's a lot. It's not leaving stones unturned. It's figuring out the fundamentals of businesses. If you do that, you're doing what Buffett does. And following his lead has never been bad. I mean, he looks like an old crank for a few years while everybody's making money on cryptocurrency, but eventually his discipline plays off. And over the long term, he does well. And he has a fundamental problem inside of Berkshire in that he always has to go elephant hunting because nothing else will move the meter. But the principles that he espouses are good principles. They work.
That's important. And I think we've entered a world where those disciplines, principles, and those fundamental, the fundamental analysis and looking at individual stocks the way that maybe a Warren would, or even just a savvy investor, has gone by the wayside in today's world, where everybody just wants to, literally TikTok is created an environment where people have a capacity to hold 60 seconds of information, and they take action on 60 seconds. And if I tell them to go watch a video on YouTube that's 15 minutes, they say, why do I have to go to YouTube? And that's what I'm seeing. And it's incredibly scary, which then results in them just clicking the easy button, which is the index. Even insurance companies have, I don't mean to swear, but bastardized this term with products like the Index Universal Life. I don't mean that that's a bad thing, but they've made it just seem like that's the almighty, the silver bullet. And I think a lot of people, from my experience, we deal with thousands and thousands of people, we're seeing that's all that they know. When I'm just like, wow, you're not looking at, these companies, you're just looking at the index. And then you mentioned that a lot of the companies in the index, they're not even profitable. Fundamentally, Warren would look at them and be like, I'm not going to spend 2 minutes looking at this company, let alone, learn 80%, because it's just a waste of his time. But that's the world we live in now.
Well, I think your point on it was the AMC or GameStop, and both of them suffer the same problem. But look at AMC. It's a theater company. I mean, this is not exactly exciting. And they have had some problems, obviously, during the pandemic, but they have a pretty knowable business model. And so people started trading them because the big bad Wall Street guys were apparently in there shorting them, which is a function of the market doing its job. But what happened in AMC, they decided, we're going to be a crypto company. So then everybody hopped in. And then they said, we're going to create our own cryptocurrency. Why wouldn't we? And then everybody hopped in. And now recently they said, we're going to be a gold company. And then everybody pops in on that. And you just got to shake your head and say, man, what are you going to do? And how do you make money? Because you know what? Uber, as cool as it is, it's a cab company. And the fact that you can hail it on your phone and track your driver is really cool. But they provide rides for you or your food, and that's how they make money. And we have to get back to the point where we look at businesses on their fundamental merits and value them. And we will. And this is what always happens when you go through a monetary transition period to control inflation.
So being a family office and having just an unbelievable team, how are you, when you're talking to your clients, what are some of the things, and I know Austin's on, if you want to jump in here too, feel free, but what are some of the things that you're telling clients? I mean, a lot of money, to the tune of tens of trillions of dollars sits in qualified retirement plans. And I used to sell a lot of 401ks, and the basket of mutual funds, because predominantly most of them still are just mutual funds, don't really give you a whole lot of selection in terms of what to do. It's so heavy in freedom or retirement plan date funds or index funds that they just don't have a lot of options. What do those people do to get ready for this? When you don't have options, and what are you telling your clients to do right now, in this odd time where we just don't know how long we have with this bull market, I guess you would say. How do you prepare your clients for this?
Well, that's a great question. I'll let Austin, if you want to talk about it, just chime in. But every client is completely different. So for example, if you created the majority of your wealth running a business, then you look at your business and find out where your pressure points are. You create very clear KPIs for your business, and you maximize the value of that business and create an environment where you can exit or monetize it at the highest possible value. But I think that term KPI is critical for everybody, not just a business. Every single person should have in their life, what are my KPIs? What are my key performance indicators? How do I maximize them? This, frankly, in times where markets are this uncertain, is a wonderful time to invest in yourself, to start a business, to get an education, to increase your education, to learn how to invest. These type of environments are investing in yourself environments, investing in your business environments, and protecting yourself. First thing you want to do is create contingency plans. Make sure that your insurance is up to speed. Make sure that you have opportunities to recover if you get the big goodbye. and get fired or something like that. But this is a great investment moment. Invest in yourself. And then do some fundamental analysis and find positions that when they come to your level, you're in. Because it's real likely that they will come to your level over the next year and a half. And so being in there would be a great time. Aside from that, there's an enormous part of the market, like about 22% of the equity market is down 30 to 40%. Now, those names, some of them are remarkably attractive, and you can go bottom fishing. Now's a great time to do it. Yes, they may go down another 5%, but when you're down 30% and you're trading below the market multiple, and you got good growth prospects and strong pricing, play. If you want to take the Warren Buffett strategy, that is the Warren Buffett strategy. Be greedy when others are fearful, and fearful when others are greedy.
Best statement ever. And then he says, to make money in investing, you just got to buy low, sell high, which is the thing most people fail to do, and don't lose money. But the first and the second, buy low, sell high, takes care of the number three. So that's just an automatic. And, the thing I always, look at is people love, to buy, whether they buy low or high, but then they fail to sell, anywhere close to the right time. And then reactions kick in because of fear when the markets go down. And then this is my experience as an advisor for all those years, is they sell at the absolute worst time, contrary to any advisor or anyone telling them, don't sell, don't sell, don't sell. This is the wrong time. They do because of reality and because of fear. And unfortunately, that's just a cyclical thing I've seen. And it comes down to sentiment. People love to invest when the market's going up and up and up, even though they're buying high, it feels good. It's like gambling. But then when it goes down, fear kicks in. And that's the point where they should be buying and they should be holding some of their most prized, positions, and they sell them because they get scared that it's going to go lower and lower, and it gets game over at that point.
In the old phrase, which is an advisor's number one job, is to tell their client no. Because the fear of regret is the most powerful emotion in investing, and it almost always encourages you to make the wrong decision.
I agree wholeheartedly with that one. And I don't know if Austin wants to jump in, at any time. Austin, just let us know if you want to kind of hop in and talk about some real stuff with clients that you're dealing with right now, and like some of the things you're doing. And then I also want to take some time too to explain what the family office, what Andina has done to serve not just the wealthy families and the traditional family office capacity, but also to help people like many of the couple hundred people that we have on here that maybe wouldn't fit a family office model because they didn't exit a business for $10 million, but they have some money and they're just lost. They don't know who to work with. And, every advisor they talk to is giving them, I don't want to say information, but information that contradicts everything Carrie just said.
Yeah, no, I think everything that Carrie said is right on point. What we try to do at Andina is your basic fundamental investment strategies. So you start with your contingency plans, your catastrophe plans, as we might say, which is why we love what you do, Chris, your whole life policies, building a family bank, and then using those assets to invest in the stock market and equities and in bonds, those types of things. But like Carrie mentioned, everybody's different. Everybody has different goals and different desires. And I think working with an advisor who can take those into perspective and develop a really customized, comprehensive financial plan is what's going to get us through all of these hard times.
And, Austin, I'll say one thing, and we had this talk offline, but this audience has never really heard me openly say this. I typically have a pretty, I don't want to say negative view, but just kind of a mixed view when it comes to the advisors out there, the majority of them. And it's not because of opinion, it's because of things that I've seen firsthand when I was in the industry and also now dealing with clients in a non-advisory capacity. So I've always been very reluctant, actually completely forcefully avoided bringing any advisor onto the show or into anything that we do. But when I met you guys and I saw what you're doing, I've always been fascinated by the family office. And I've always said to myself, I just wish that there was a way to bring the average person, with whatever, a couple $100,000 in assets, to the level of what these wealthy family offices and these wealthy families are doing investing, because it's totally the opposite. It's totally different, compared to the way that I was taught to invest money for people to the way that you guys invest money. It's such a different degree of separation that I never ever even thought that there'd be a way for a family office to actually help the average client. But you guys have figured that out. You've bridged that gap. I don't know if you're the first, but you're the first I've ever heard. And when I saw this, and I was around your campfire for a while and understanding what you're doing, I finally said, listen, like, clients need this. Our people need what you do, because it's not the traditional cookie cutter financial advisor stuff. And I'm not going to name any of the wirehouses or the brokerages out there, but you all know them. You see the ads for them every day, including on the Super Bowl. It's not the cookie cutter stuff. It's different. And I think that's just such a remarkable thing that you're doing by helping the people and bringing what the only, in the past, only the wealthiest people could get access to. And now, I'm not going to say everybody, but a larger percentage of the people out there that invest have access to this with you.
Right. Yeah. And what you're talking about is the difference between comprehensive financial planning on a fee-based system versus something that's commission-based. At Andina, we act as fiduciaries, and our first priority is to do what's best for the client, not what's necessarily best for me as the advisor as far as getting paid is concerned. And so what we've done with Andina is we have our Andina family offices, which does typically cater to the higher end, higher net worth individual, but we do have the Andina advisors side of things that is catering to the people that have maybe $100,000-$200,000 of investable assets, giving you access to some of those options that you might not otherwise have, because we have our own sophisticated family office built in to Andina advisors.
Love it. Now, folks, I just want to gauge everything and make sure everybody, is still with us and nobody's fallen asleep and everybody got back on their chair. How many of you would love to have access to someone like Kerry, like with his ultimate wisdom of what you've heard? How many of you would love to have that and wish your advisor had somebody like Kerry that was giving them the advice that isn't just buy, it's going to the moon, like the actual, like, I'm not going to say doomsday stuff, but like, hey, this is reality. The chance of the Fed pulling us off is 0. And we need to help you based on your circumstances, your needs, and your goals in an appropriate way to plan for this, so you don't have to give everything you've just made back. How many of you would like that? Put I in the chat and we'll wait a second. Yep. There we go. Every one of you. Now, let me just go one more round. How many of you actually have somebody that helps you with your investing that has a Kerry or someone like Kerry that helps them? Can you put, just put nope. Colleen put my name. Yeah, no one. Yeah. I'm just waiting to see if anyone does here. Somebody's got to have somebody, right? I mean, none of you are working with Ray Dalio's company? Really? I'm surprised. None of you are hanging out with Warren Buffett and Munger? No? All right. One. There we go. Susan's got one. That's awesome. Susan, if you have somebody that actually works in that capacity, don't ever let them go, ever, because it's so rare. You just saw it. So rare. Yeah, Colleen, all you need to do is get Warren Buffett some cherry Coca-Cola and he'll be your friend. It's all. All right. So, Kerry, where should we go next? So we've kind of laid out some of the big things that are pretty front and forward. We haven't really talked about Russia, Ukraine. We haven't really talked about the long-term debt cycle and even the short-term debt cycle and how those debt cycles are kind of all, right at the end, if not past the end. So what are some things that people could look at with that, just to, if they're still not believing that there's a problem coming, then maybe they need to look at additional things.
Yeah, a couple of things. Number one, let me follow up on what Austin said. Within Andina, there are some large clients, but the reality is those clients weren't large when they started with Andina. Andina Family Offices is about as much of a mindset as it is being a client. And so everybody needs to start thinking like a family office well before you want or need a family office. And I think that's what Andina Advisors does, is it brings clients into the fold before they probably have a need or interest in all of the services of a family office, and gives them the mentality, helps them with their business, helps them have opportunities as they become available in unusual places, real estate, private credit, private equity. And then as they qualify for those, and as they become available, they're there. And even if they don't qualify for them, to be able to look at that and aspirationally go, okay, where do I need to go money-wise and wealth-wise to where I can take advantage of them? And I think that's the huge power in Andina that you just will not get elsewhere. I think that's pretty important. Anyway, I'm talking my own book there.
No, I think that's great because you're absolutely right. And a lot of times when people look at someone like Andina in a family office capacity, they're like, well, I could never ever be there. But they don't realize that a lot of your clients, they weren't where they're at today. They've grown with you, and you as a company have grown with them. And that's a symbiotic relationship. That's what every one of us should be striving for. I mean, and I know many of the people on here, have been around our campfire, and look, as we've grown, our clients have grown. It's the same thing. And I love that you mentioned that. Yeah. So I don't know, folks, I just put the link up. I want all of you to check out the website. They just redid their entire website. It's got everything in there, and if any of you just want to set up a call with Austin and get, on the phone just to talk about it, maybe you like your advisor, you've been with them forever, but they just don't seem to be as current as what we're talking about here and ready to help prepare for these hard truths that might be coming, then book a call with them and get on the phone. Listen, like the one thing I'll tell you all, and I want to be very crystal clear about this, most all of you know me or have been around this campfire. I don't bring people on this show unless I ultimately trust them. I have zero, I want to repeat this, zero to gain by you setting up calls with Austin and Andina. Zero. There's no affiliate. I can't be paid. I'm not licensed anymore. I gave up my Series 7. Thank God. God, thank you. Thank you for taking that away from me. But anyway, I no longer have that. I can't be compensated in any way capacity at all. The reason we wanted to do this today is because their services are services you need that we, Money School, Money Multiplier, cannot provide to you. Period. We can't. We can't manage your money, nor do we want to manage your money. We don't do all the things. I might talk about the financial markets. I might talk about Wall Street and all the things you hear, but you ever hear me saying, oh, let us manage your money? It's because we don't. That's what they do. They are experts. If I'm working with an advisory company, this is the one I'm working with. Okay. Hands down. Even though right now I don't have any money outside of our private hedge fund in the markets, that doesn't mean that's the right fit for you. To each their own, and everybody's got their own risk reward profile. Me, I'm just waiting. I'm just literally, I'm Warren Buffett sitting back being bored waiting, but I'm doing other things. But you might not be there, and you might not be able to be where I'm at. So please, if this is something of interest, book a call with them. They're not going to try to sell you something. They're just going to hear out what you do, what your needs and goals are. And if there's a fit, and only if there's a fit, then you two can talk it out. And again, I want to be, again, clear, because I know a lot of people are like, oh, why are you talking about them so, positively? I have zero to gain. Zero. You didn't pay to be here, and they're not paying me a penny. The best payment I ever get is Carrie's show that he does, The Weekender. That's my payment. I read that. I listen to that. That's how I get a lot of my knowledge. All right. So I got to get off that one, but yeah, I think I went a little too far with that. Carrie, where do we want to go next? Sorry. I just get so excited because if it's something I can't do, it's something that the clients may need. And I wanted to make sure we made that clear.
Hey, Chris, real quickly, I'll put my email in the chat box so everybody can have it if you wanted to reach out. But to give everybody an idea, the first consultation or talk through, we just want to understand where you're at and what your goals are. And if Andina can't help you, we'd be happy to point you in a direction where you want to go. But we want to understand your needs, your goals, and then we can go from there. So I'll put my email in the chat, and anybody can reach out to me and ask me any questions if they'd like to. And then we are creating a whole new Andina Advisors website that'll be up here in a couple of weeks. The Andina Family Office is the one that you shared, Chris, but look for that. And if you guys have questions, I'm happy to help.
Awesome. Thank you, Austin. And one other thing, just before we get back in with Carrie, is this past week, and I said we did a 3-day event. Many of you were there. Many of you were not. We've done something that we've never, ever done in history. We actually recorded the 3-day thing. We edited it down. We time-stamped it so that everything was there. And now it's available to all of you. Steven's going to put the link up. It's $97 plus we give you a bunch of extra stuff. So if you want that training, which may very well have been one of the best trainings we've ever done, especially for what we're talking about here, day one of that training is worth $9,000, let alone $97, because it covers all of this stuff that you've heard Carrie talking about. It goes in depth. It gives you step by step things that you can do to protect your wealth, to make sure that you're ready for this storm that's coming. And so that this storm that's coming doesn't create a cliff that you're going to fall off of. It creates the biggest opportunity of your life. So I urge any of you, if you weren't at the 3-day, listen to some of the comments that come in here about the ones that were, grab the training, grab the recordings and watch it. Even if you just watch day 1, it'll be worth every penny. So sorry about that little shameless plug I had to throw in there. Carrie, where should we go next?
All right. I just put a graph up on, which is consumer sentiment.
Oh, yeah, this would be good.
We have a really strong economy with a really low unemployment rate. And yet consumer sentiment is coming down to where it was during the credit crisis. And you got to ask yourself, what's going on? And what is going on is the power of inflation in the mentality of consumers. The 70% of our economy is consumption. So it really matters. And if consumers are worried, consumers are feeling the pinch of inflation, they're going to retrench and they're going to buy less. And it's going to show up in company earnings. It's going to show up in the economy. And eventually, with a little bit of help from the Fed raising rates and stop purchasing securities, it's going to show up in inflation. It's going to show up in demand destruction. So what is being stressed right now is the robustness of the economy, and it is true. And that robustness goes away within the next quarter because we've restocked all of our inventory, we've met proximate demand, and now we're looking at it going, okay, what's the run rate from here? And sincerely, we haven't been to that point before, but it's important to see that I'm showing data that's negative, not because I'm negative, but because it reflects an inflection point. We're moving from positive data to negative data, and I'm not depressed, I'm not negative necessarily. I'm saying the game and the rules are changing, and you need to be able to adjust to changing rules. And the opportunity is still there, but it's just different opportunities. So recognize that the rules are changing and recognize that we need to change our view and our positions on things and adjust for them and take advantage of the opportunity as they present themselves. So one that I think forward looking, and if you don't mind, I'm going to go back in time to when I was your age. In 1992, a wonderful book was written by a guy named Francis Fukuyama. It was called The End of History and the Last Man. Now, the context of the book was 1989, the Berlin Wall came down, and we entered this moment in time where China was growing, and China is growing in what they called a peaceful rise. They sort of label everything, and so that was the label of the rise at the time. Russia was pretty much in the mode of giving up all their satellite countries, trying to turn into a capitalist free market environment to the extent that they could, and completely altering their economic structure. And we were creating a global economy, and it was truly global. And we were able to import deflation from China. If you look at the trade data, what you'll notice is that China became the global manufacturer, and now we stopped making things in the United States, and we imported them from China because they could do it cheaper. And what that allowed us to do is that cheapness became imported deflation. So we were able to continue to lower rates because inflation wasn't happening, because we were actually importing lower prices from China. China was experiencing inflation. So we actually exported inflation and we imported their goods. And in a very remarkable way, this book said, you know what, we're going into a global kumbaya where everybody's just going to get along. And social democracies are going to take over the world, and we're all going to love each other, and it's all going to be great. And that's where all these ideas of a new world order came up. And we just didn't go there. We went there for a while. And then the Chinese economy became the second largest in the world. And they started to say, hey, look, we're the second biggest in the world. Why do we not have a seat at the table of discussions that we didn't have because we were smaller or a communist? And we want those seats. And they started exercising their power, their influence, their might. And that and other events caused us to start to break this world system apart. And then the pandemic came, and completely altered the supply chains upon which we relied. And now we're stepping back going, what should we rebuild and what should we not rebuild? And the Ukraine situation is drawing lines more forcefully than we could have ever imagined. And now we have a new environment where NATO gets stronger, where Russia's teaming up more than they were before with China. And China's done a remarkable job at investing in other countries in Africa and South America, a lot of them resource rich, because they know that they're going to need resources. And this is creating a bipolar world again. And it maybe doesn't go back to a Cold War, but it certainly changes the playing ground and the landscape from what we were experiencing as short as 2 years ago. So that is perhaps the biggest move. And along with that is something consistent with, hey, look, Russia says, I don't want to sell my oil in dollars. And China says, I don't want to buy them in dollars. Well, let's create a different currency that we can use so we don't have to use dollars. And this is a really legitimate argument on their part and something they can do now because the resources and the systems are in place to be able to do it. And it completely changes the power landscape in the world. And I think that is a structural shift that takes a generation to play out, but creates absolutely stunning opportunities for investment, for growth, for changes, and something that is probably the largest investable theme right there with artificial intelligence, but tied to artificial intelligence and things related to the metaverse and things like that over the next generation. But it's absolutely remarkable what kind of opportunities that's going to get. And one of them is the dollar goes down.
Absolutely.
If the dollar is not the reserve currency anymore, which it shouldn't be, if you looked at the US economy as a strong economy in terms of its national accounts, we are slightly above Zimbabwe. And that's a problem. What we are now is because we have the luxury of being the global fiat currency, the gift that was granted to us in 1945 as part of the Bretton Woods Agreement, when we were the only economy standing after World War II. And that's going away. And that is an enormous shift. It shouldn't be interpreted as being negative because there are an incredible group of positive outcomes that come from that.
I couldn't agree with that more. And, that's something, what you just said is something that most of you that are listening to the news and anything, you won't hear that being discussed. Depending on what you believe about the media, whether it's real or controlled, but you just won't hear that because if you really think of the Fed and just understand the Fed is not the US government, they're, group of bankers. We'll leave it at that. You can read the book, The Creature from Jekyll Island or Secrets of the Federal Reserve. You can understand the Fed, but the Fed's number one job is to protect the dollar. And right now, kind of out of left field, if you will, the dollar is now being threatened because of sanctions that the US put on Russia, which then triggered some, I don't know if they predicted that to happen. I mean, they've done sanctions many other times, but now all of a sudden it made the world look at it going, you know what? I don't like this whole thing where the US dollar is what we all have to trade in, because once they put sanctions on, then all of a sudden, hey, maybe it's Russia, but next it could be us. We don't want that to happen. We're going to find workarounds, and Russia's kind of paving the way with that. And for the Fed, I have to think about it. I mean, if the Fed's number one job is to protect the dollar, their best product that they've ever created, because they have an infinite amount of it, because they can just print. And now all of a sudden, if that's being threatened, to what length will the Fed go to protect it? And what levers will they push, which is something that scares the tar out of me. I think you're right, with the dollar kind of going by the wayside as the reserve currency provides just massive opportunity in so many different places. But yeah. What is that stepping stone going to look like when the Fed realizes they got to do something to protect their most valuable product?
Yeah, I think they're, to the extent in the short term, they're sort of caught with their hands tied behind their backs because they have to raise rates. So that causes a short-term support for the dollar. But once they move past that and they let the economy reset to its normal, that's when I think those things step into being. And Saudi Arabia has expressed willingness to change their sales of crude oil. They've always said, look, it's got to be in dollars. And now they said, nah, we'll put it in yuan. We'll put it in rubles. It doesn't matter. We can fix that. So that you've got one of the largest, 10th largest producer of oil, and Venezuela will be right behind them. If Venezuela doesn't have to buy dollars, they'd love to not do that. And you start to tick away the countries that would love to not have to use the dollar. That gives all of the resource-rich countries their monetary policy back instead of hooking themselves to the U.S. And
Yeah,
they'd all love to do that.
that's a very interesting topic, one that, like I said, you're just not hearing much about it. Somebody had just asked, and I thought it was a very relevant question. What are your thoughts on the World Economic Forum and Klaus Schwab? You've heard his name pop up a little bit. I mean, have you ever seen the man smile? Is my first question. Secondarily, like, what are your thoughts of the crazy stuff that him and his little weasel are talking about?
You know, I went to the anniversary of the liberation of Auschwitz. And when you go through that, I had some wonderful friends who were Polish, and they took me there. We went to the bottom of the deepest coal mine in the world, which was much less inspiring than Auschwitz. And so we went to Auschwitz-Birkenau and we toured, and it was absolutely revealing. I've read about every possible scenario you could imagine. My family was half German and half Danish, and so we had the good side and the bad side. And what was interesting to me is they have never gotten over the war. The folks in Poland, they're celebrating, but they're saying, we didn't get liberated. We got taken over by somebody different. And this sense of the acute pain of the war lives on in almost every country in Europe. And you can see that now as they rally around NATO from the events that transpired in Ukraine and Russia. I hope that, you know, World Economic Forum, all these other groups that have ideas that are completely untested or that have been tested and proven to not work, I hope that somewhere along the way we are able to BS test them and put them back in their box, because the level of stupid that comes out of these places is absolutely remarkable.
Yeah, I think of someone like Klaus Schwab. You know, when my cat's angry and I got to put it in the cat carrier to take it to the vet, I picture like that same kind of go around being like what it would be like to put Klaus into the little box. I feel like we're going to get scratched and lots of hissing, because I don't know. I'm just trying to make people laugh. Yeah, the Klaus Schwab stuff is pretty downright scary, the things that come out of that man's mouth and what that whole thing means. But, you know, folks, as you're kind of hearing this stuff, put your questions in the Q&A. I know a lot of them are coming into the chat, but it's just there's too many people for us to track that. So if you have questions, we're going to leave a little bit of time at the end to answer them. Throw them over in the Q&A, and that'll gauge how many questions we're going to get, so I know how much time to throw in there. One other thing, Carrie, I want to comment and commend you on is, unlike Klaus, who never smiles, you are full of smiles. I love that. Like the whole time I've been like looking at the screen, you're always smiling. It just means you love what you do. And that gives me this nice warm feeling. But one thing we haven't really talked about, and it might be a very short conversation, is crypto. There's a lot of people out there that are fully, you know, buying into and believing crypto and really kind of going deep into it, good, bad, or indifferent. But what is your take on crypto, its longevity, the impact that the CBDC could possibly have against like a Bitcoin? I mean, just unpack that however you want.
So I am unconvinced by crypto. I have been told that I am old, which is not a revelation, and that I just don't understand. I remember a moment in 1999 when I moved from London to Bellevue, Washington, and everybody was talking about the internet, and I sat down with people and they say, Wazin, you just don't get it. It's not about profits, it's about eyeballs. And I just couldn't wrap my head around that. I look at crypto as a transactional tool. And as a transactional tool, is there use? Absolutely. Is it safe? No, we're breaking into that all the time. The FBI is able to pinch in there and grab money with reckless abandon. So is it as safe as everybody pretends it to be? No. Is there a body to where you can redress your grievances? Can you go back and say, this is wrong? Something has happened? No. There's been many billions of dollars stolen through the system. That's supposed to be not possible. And besides that, is there any country that in the final conclusion will allow their monetary policy to be managed by a group of people that nobody can touch, feel, or talk to? I don't see how that works. So I sat down with a gentleman who was an expert and had made millions on crypto and NFTs, and he walked me through all of it. And I expected to be convinced, at least at some level, that this was a thing. And I came out even more convinced on the opposite side. I looked at the data on how much of this is used for transactions, and it almost hasn't budged for years. So it's not actually being used the way everybody says it should be used, and therefore what its value is, it's a measure of animal spirits in the market. And so I am anxious to be convinced otherwise, but I'd love to be wrong about this one. But
yeah, I think a lot of people would like to be wrong. Warren Buffett to be one of them.
Yeah, but I just can't get my hand around it. And I've read all the books. I've listened to Ray's comments about it. Mungers are pretty strong. So, I've tried to listen to the smart people on both sides. And I cannot get myself to an investment case other than as an alternative transaction infrastructure, it would have a huge value.
Yeah.
But as an inherent value in the coin itself, what's driving the value?
There is no intrinsic value, none.
Yeah, I can't get there.
Yeah. So it just comes down to, with crypto and what there's so many coins and things you can invest in. I mean, really, we have both sides. We have Spencer Montgomery, who we get a lot of our knowledge from. And, there's a lot of case to be made, but you just understand that any of the cryptos for the most part are based on investor confidence, and the price of Bitcoin and the others largely due to investor confidence. You see it every day. I've been following it today. I mean, it's been on another downward spiral. It's trending very much with the markets. So a lot of people in the early days said it was non-correlated to the stock market. I've never seen anything so unbelievably correlated to the markets as crypto, which is what it was supposed to not be. But it is absolutely trending almost like literally to the T with the markets, which scares me ultimately, because if what you've just heard for the last over an hour about the markets and everything the 3-day training taught you about the markets, then there should be some concern about crypto as well, because it is not going to be the gold, the gold alternative that you think. It just so far has failed to be that. And that's my take. I do invest in it, but I invest in it just like any other Wall Street guy, support and resistance levels. I take tiny little profits on high frequency out of it. And that's just how I've played it. And I keep waiting and kind of learning more and more about it. I think it'll be around for a long time, as long as there's investor confidence.
Well, and I was in a previous life, I was the analyst that uncovered Enron, and everybody would say, well, how did you do it? What did you do? And they assumed I had this incredible set of analysis that uncovered it. And it's not. All I did was I said, what do they say they do? And then I tested it and found they were wrong. And so I do the same thing with crypto. I say, what do you say you're good at? And if I test you and find that's not true, then the foundation upon which you're based doesn't exist. And so far, that's where I end up.
Fantastic. Well, what I'm going to do, Carrie, if you don't mind, and I want to make sure I'm very, observant of your time. If you could, we have about 7 questions. Would you mind answering a couple questions?
Sure. I can do a rapid fire.
Rapid fire. Jim Collins, Warren Buffett, question, comment. Buffett has been buying mobile home manufacturers, Fleetwood, et cetera, and the companies that finance those purchase for a few years. Are we coming to a point where we only affordable homes and trailers? So basically saying, could there be a time where affordable homes are high demand? And that's kind of what Warren Buffett's been, preparing for.
I think that's true. And I looked at this space. In fact, I have plans for them right here.
You're going to build some?
No, well, I'm going to build a house. And so I thought I could put this on my lot, live in it while I'm building a house. So that was my idea. And so as I went through it, I went to these places and went to a number of them, and they all have 6 to 9 month waiting lists, and they've been ordering as fast as they can. So they're operating at capacity. I'd be careful though. 40% drop in mortgage demand last month.
I saw that.
So these are scary numbers. And when you see any sort of number like that, you realize the sensitivity of interest rates, of purchases to interest rates, and these type of assets, these mobile home things, they don't qualify under the same mortgage rules as others. They're higher risk. And so they're more sensitive. The convexity of their curve is a little bit higher than the regular mortgage market. So I'd be concerned that what appears to be good on price, we lose out on financing. And a lot of banks just won't finance them anyway. But the same line, I'd do some research on RVs. Lots of people bought RVs, and lots of people are turning them back in. And RV manufacturers are pumping them out as fast as you can. Almost all RV dealers are full of inventory, and that's a little bit early. So it tells you we got a surplus problem coming up, and I'd be concerned about, in general, manufacturers who ramped up to meet proximate demand, expecting it to continue. They're finding themselves a little full.
Yeah, folks, it's not the first time we've had that problem either. I think that's a very good observation. I knew that was going to happen with RVs. You're going to see the same thing with cars. So listen, if you guys are looking for a new car, maybe just wait a little bit. You'll probably get a really good deal end of year when they're trying to blow out their massive, massive inventories that they built up, hoping the demand would remain. Chris Ash said, and I think this is a great question, if the US dollar eventually is not the main world reserve currency, what kind of investing opportunities would this create? I'll say one right off the bat. I went to my trader and I said, hey, listen, when this whole thing happened with Russia, Ukraine, and the ruble dropped to, about a penny, I said, how do we buy this? Through all the research, he said, you can't. That would have been a great investing opportunity, and we would have probably made a ton of money because it's almost rebounded. But what other opportunities of things that we could actually do would come out of that?
That's a great question. But you think about all the things we've moved abroad because of the strength of the dollar, we'll move back because of its weakness.
Oh my gosh, never thought about that.
Now that under the same environment, look at the things that are now more tenuous. Geez, look at the container shipment costs. They're 4 times what they were a year ago. Yeah, that's going to come back, but it's not going to come back completely. And so the economics of moving things to China or Vietnam or somewhere else, their wage rates have gone up by 19% per year. So the math there just doesn't work anyway. And you devalue your currency by 10 or 15%, you start to see people saying, well, why am I over there? I'm going to bring a lot of those things back. You create a security issue around a lot of the technology, which the government is going to put in place, and that forces them back. And all of those things are really good because you know what? A lot of our high value stuff we've sent abroad, we start bringing that back. Those are really good paying jobs. I'm thinking AI, technology related stuff. Apple's already doing it. They're pushing things down into San Antonio for manufacturing. Why? Because they can't rely on the supply chain anymore. They need to have things closer to home. And I think that is a generational trend. Just going to go on.
Wow, Kerry, that's my golden nugget for today. I got a lot of great stuff, but like right there, that is the one thing it didn't cross my mind that just makes all the logical sense in the world. I saw an article about a farm, like a family, they lived there for 40 years, this little plot of land, this tiny little house, and right in the way of what Apple wanted to build down there in Texas. And they sold it to Apple for $1.7 million, but they told Apple, no, so long. They just held out and got their price. It was a great story. All right. This one is from TJ. He said, what is the impact of the Great Reset on whole life insurance company, or specifically giant mutually owned insurance companies? Will the cash value and the death benefit even mean anything anymore? Is there any way to protect against that being diminished?
I wouldn't know.
I would tell you, TJ, I can kind of hit that one because we've spoken to a lot of the higher ups, including the vice presidents at the mutually owned companies. They're so well diversified in the different things. Yes, it's all denominated in US dollars because that's our means of exchange. But I think if that's what you're worrying about, maybe buy one of those big concrete things that you just kind of load up with food and ammo and you go there, because like that's about where we'd be at. I don't think you're going to be worrying about the things that you're asking the question if we ever get to a point where those things are threatened. But until then, carry on. It's like that movie, Carry On, Wayne, carry on, Garth. That's it. Donna said, can you elaborate on who is Klaus? Klaus Schwab. I think she's confusing Charles Schwab, the guy you see in the commercials, with Klaus Schwab. Just Google his name and you probably won't like what you see. I don't know if you want to comment on that, Carrie, but it's.
No, I think that's good. There have been enough people who
absolutely
talk about him.
Sheila said, are we looking at an SDR basket of currencies as the shared use of global monies?
Yeah, we've tried to push that for 30 years, and it's never gotten any traction. Right now, you're looking at a basket. So China and Russia are doing a trade-weighted basket of their two currencies. So they're not feeling the need to diversify. And frankly, the only reason why we have a lot of baskets is for either diversification protection or the fact that we have an analytical problem. And we don't have an analytical problem anymore. We can do that pretty easily. So I wouldn't expect that you get an alternative to the dollar that is dominant. I think what you get is many alternatives to the dollar that are case specific.
Great. Brian said, and this one was covered, but I'm going to have Austin. This would be a great opportunity for him to throw up his contact info again. Brian's just asking, what is the minimum net worth or investable assets for this to make sense to work with you?
Really anything. Come to us with what you're hoping to get out of an advisor, and we'll see if we can help you out. Our typical client will have anywhere from $100,000 or more in investable assets, but that's the whole point of the advisors side of Andina, is to work with the up and coming affluent. Just like Carrie mentioned, majority of our clients weren't wealthy when they started with us. They sold a business, became wealthy, and we just want to be there from the beginning. So really anything. If you have questions, I'm happy to answer them.
Love it. Yeah, just toss your email back in the chat there, just so anyone that you wants to can set up a call with them just to talk it through. Chris Ash is asking, what is Carrie's take on digital currency talk that keeps getting mentioned these days? We kind of hit that a little bit.
Yeah, the one thing that you mentioned that I think is absolutely critical to enforce is, look, the fundamental value of Bitcoin was supposed to be based on its unique scarcity, which required all this mining and things like that. The reality is 13 new cryptocurrencies are formed every week. So if you can form a currency that easily, and some of those become major currencies worth billions of dollars, there is no scarcity. So if scarcity isn't a fundamental element of the value of a currency, how does it hold its value? And that's a huge problem that nobody seems to get over. Everybody's just sort of Twitter-pated by the next new currency that comes out. So I think you don't need to in any false way create scarcity, but if there isn't a fundamental bedrock in value, which scarcity creates, you got a long-term problem.
Absolutely. And then Patrick is the last question. He said, what's some good research tools to keep in touch with financial markets, stock markets, investing, and other big wealth topics impacts? Any suggestions there where the person could just kind of get through the crap that's put in the media and get to the real good stuff that they need to be learning?
That is a phenomenal business idea.
Solve the problem, Patrick, solve the problem.
But when you look at the way the internet has emerged, it starts with creating a platform, and then it all eventually comes down to content. In investing, we're in the same position. We've created a free platform. You can trade for free. Now, what Robinhood has not done, they've tried to do it with their little bites and things like that. They've not created any sort of guidance, and they've not created any sort of foundation for good information. Because now everybody trades for free. So that's no longer a competitive advantage. I would expect that some bright souls step into that hole and fill it. But at the moment, you really should find an Austin Scott who can help you guide you through that mess, because there isn't anything out there.
That's some good.
But also, Carrie, let me toot your horn here and talk about your weekender that you do. So for those who don't know, Carrie does a weekender every week. it's just on basic market conditions, and it's really well put together. It's about 20-minute video at longest, where Carrie goes through his research and talks about what's going on in the market. And that is something that if you guys want to be a part of, I can put you on the email list. Just send me your name and email, and I'll go ahead and put you down for that.
Yeah, that's, you listen, like, you know, we got still well into the hundreds of people on here. Every single one of you right now, I'm just going to pause for a second, cut and paste right there, cut and paste that email address. Okay, I just put it up there again, and I'm going to do it again. And what I want all of you to do is I want you to email him and say, please put me on the list for the Weekender. You will love it. So the question that Patrick asked is like, where do I get info? There you go. Secondarily, like, Patrick, get around our campfire. This is all we ever talk about. Sometimes I feel like we talk about it too much, but everybody asks for more of it. So we keep dishing it out. Like, we're trying to cut through the nonsense and the traditional stuff and give you the stuff you need at the right time when that's there. And that's what the Weekender does. You know, this toot Carrie's horn a little bit. Like, when I listen to the Weekender, like, I get things to then talk about and teach. So I'm almost repurposing some of the stuff he's talking about because it's so in line in trying to get his reach out there. But right now we got all these people. Email that and get the Weekender. It's the best advice you can get right there.
And it is free, Chris.
Yeah, absolutely. Yeah. And everybody on here, none of you paid to be here. So you obviously like free things. So get the Weekender. That's the best thing. So
What's your date?
you can't click the link. So we'll cover that in a second. I want to cut Carrie and be respectful of his time. So folks, put your hands together for Carrie and for Austin. They did a phenomenal job today. Some great information. And I just want to make sure I personally thank you both. Thank you for coming on, taking the time. It was amazing. And I'll look forward to the next weekend.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.